Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets by Nassim Nicholas Taleb is a book that explores the impact of randomness on our lives and how it can lead us to make incorrect assumptions about the world around us. Here are 10 main points from the book. 1. Randomness plays a significant role in our lives, but we often fail to acknowledge it. We have a tendency to attribute outcomes to skill, talent, or hard work, rather than acknowledging the role of luck. 2. We are often fooled by randomness, which means that we assume that an event is more significant than it really is, simply because it is unusual or surprising. 3. The impact of randomness can be seen in financial markets, where many investors and traders attribute their success to skill, when in reality, luck may have played a significant role. 4. The concept of the black swan refers to a rare, unpredictable event that has a significant impact. These events are often assumed to be impossible or highly unlikely, but they can have a profound effect on our lives. 5. The human brain is not well equipped to deal with randomness, as we have a tendency to see patterns and connections where none exist. 6. The illusion of control is a common cognitive bias, where we believe that we have more control over events than we really do. 7. A focus on short-term outcomes can lead to incorrect assumptions about the role of luck, as chance events can have a significant impact over the long term. 8. A willingness to take risks is often associated with success, but it is important to recognize that luck can play a significant role in the outcome of risky ventures. 9. The importance of understanding the role of randomness in our lives extends beyond financial markets, as it can impact our personal relationships, careers, and other areas of life. 10. To avoid being fooled by randomness, it is important to remain skeptical, question assumptions, and acknowledge the role of luck in our lives. Point 1 from Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets highlights the fact that randomness plays a significant role in our lives, but we often fail to acknowledge it. This means that we tend to overlook the impact of chance events, and instead attribute outcomes to skill, talent, or hard work. For example, imagine that two people both start their own businesses around the same time. One of them is successful and grows their business rapidly, while the other struggles and eventually fails. It would be easy to assume that the successful business owner must be more skilled or talented, and that the failed business owner must have made mistakes or lack the necessary abilities. However, it's important to recognize that luck may have played a significant role in the outcomes of these businesses. The successful business owner may have benefited from a chance encounter with an influential client, or from favorable economic conditions. The failed business owner may have been unlucky with their location or had unforeseen setbacks that were outside of their control. By acknowledging the role of randomness in our lives, we can avoid making incorrect assumptions about the causes of our success or failure. This can help us to remain humble, and to avoid becoming overly confident or complacent. It can also help us to appreciate the role that luck can play in our lives, and to be more empathetic towards others who may have experienced setbacks or challenges that were outside of their control. Point 2 from Fooled by Randomness, The Hidden Role of Chance in Life and in the Markets highlights the fact that we are often fooled by randomness. This means that we can be misled into believing that an event is more significant or meaningful than it really is, simply because it is unusual or surprising. For example, imagine that a stock trader makes a series of risky investments and has several successes in a row. It would be easy for the trader to attribute their success to their own skill or intuition, when in reality, luck may have played a significant role in their outcomes. Similarly, if the trader experiences a sudden and unexpected loss, they may be tempted to blame external factors or bad luck, rather than acknowledging that their success was largely due to chance. In our everyday lives, we can also be fooled by randomness in a variety of ways. For example, we may attribute an unusual coincidence to fate or destiny, when in reality, it was simply a chance occurrence. We may also overlook the impact of small but significant events, such as a chance encounter with a new friend or a missed opportunity, that can have a profound impact on our lives over time. By recognizing the role of randomness in our lives, we can avoid being fooled by unusual events and can develop a more realistic and balanced perspective. This can help us to avoid making incorrect assumptions about cause and effect, and to appreciate the impact of chance events on our lives. It can also help us to develop greater humility and open-mindedness, and to be more willing to consider alternative explanations for our experiences. Point 3 from Fooled by Randomness, The hidden role of chance in life and in the markets highlights the fact that the impact of randomness can be seen in financial markets, where many investors and traders attribute their success to skill, when in reality, luck may have played a significant role. Financial markets are inherently uncertain and subject to a variety of unpredictable factors, such as economic conditions, political events, and technological advancements. Despite this, many investors and traders believe that they have the ability to predict market movements and to make profitable trades based on their own skill and expertise. In reality, however, the outcomes of financial investments are often influenced by chance events that are outside of our control. For example, a sudden change in interest rates or a political upheaval can have a significant impact on stock prices, even if the underlying companies are fundamentally sound. Additionally, the fact that some investors or traders may have experienced success in the past does not necessarily mean that they have superior skills or knowledge. Instead, their success may be due to chance events or random fluctuations in the market. By acknowledging the role of randomness in financial markets, investors and traders can avoid overestimating their own abilities and making risky or ill-informed decisions. It can also help them to develop a more realistic and balanced perspective on market outcomes, and to appreciate the impact of external factors on investment performance. This can lead to more prudent decision-making and a greater likelihood of long-term success. Point 4 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that human beings are wired to seek patterns and explanations for events, even when they are random or unexplainable. Our brains are naturally inclined to look for cause and effect relationships in the world around us. This is a valuable cognitive ability that allows us to make sense of complex information and to navigate our environment more effectively. However, this tendency to seek patterns can also lead us astray, particularly when it comes to interpreting chance events. For example, we may see patterns or trends in random sequences of numbers or events, or we may attribute significance to coincidences or unrelated occurrences. In financial markets, this tendency to seek patterns can lead to a phenomenon known as overfitting, where investors or traders rely too heavily on past data and patterns, without accounting for the potential impact of randomness. This can lead to poorly performing investment strategies and increased risk. By recognizing our tendency to seek patterns and explanations, we can develop a more cautious and nuanced approach to interpreting chance events. We can also be more open to alternative explanations and more willing to acknowledge the role of randomness in our lives and in financial markets. This can lead to more rational decision-making and a greater likelihood of success over the long term. Point 5 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that outliers, or extreme events, can have a disproportionate impact on our lives and in financial markets. Outliers are events or occurrences that are highly unusual or unexpected, and that fall outside of the normal range of outcomes. These events can have a profound impact on our lives, both positive and negative. For example, winning the lottery or inheriting a large sum of money are both examples of positive outliers, while experiencing a sudden illness or personal tragedy are examples of negative outliers. In financial markets, outliers can have a significant impact on investment performance, particularly for investors or traders who are heavily exposed to a single stock or asset class. For example, a sudden market crash or economic crisis can wipe out years of investment gains and lead to significant losses. Despite their potential impact, outliers are often difficult to predict or plan for. This is because they are by definition outside of the normal range of outcomes, and are often influenced by chance events or unforeseen circumstances. By recognizing the potential impact of outliers, we can develop a more robust approach to risk management and decision-making. We can also be more open to the possibility of unexpected events and more willing to consider alternative scenarios and outcomes. This can help us to prepare for the unexpected and to navigate through periods of uncertainty and volatility with greater confidence and resilience. Point 6 from Fooled by Randomness, the hidden role of chance in life and in the markets emphasizes the fact that hindsight bias can distort our perceptions of past events and outcomes. Hindsight bias is the tendency to view past events as more predictable and less uncertain than they actually were. This bias can arise because, after an event has occurred, we often have access to more information and insights than we did at the time. This can lead us to believe that we could have predicted the outcome if only we had paid closer attention or had more information. In financial markets, Hindsight bias can lead to overconfidence and a false sense of security. For example, investors who benefited from a long period of positive returns may believe that their investment strategy is foolproof and may take on excessive risk, without accounting for the potential impact of chance events. Similarly, traders who have made profitable trades in the past may attribute their success to their own skill or expertise, without considering the role of randomness in the outcome. By recognizing the impact of hindsight bias, we can develop a more realistic and nuanced perspective on past events and outcomes. We can also be more humble in our approach to decision-making and more open to the possibility of unexpected outcomes or random events. This can lead to more prudent and disciplined decision-making and a greater likelihood of long-term success in financial markets and in other areas of life. Point 7 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that small differences in skill or luck can have a significant impact on outcomes over time. In many areas of life, small differences in skill or luck can accumulate over time and lead to significant differences in outcomes. For example, in sports, a small advantage in speed, strength, or technique can make the difference between winning and losing, and can have a significant impact on an athlete's career. In financial markets, small differences in investment performance can also accumulate over time and lead to significant differences in wealth accumulation. For example, an investment strategy that outperforms the market by just a few percentage points each year can lead to significant wealth accumulation over a long period of time. However, it is often difficult to distinguish between skill and luck in these types of situations. For example, a successful trader or investor may attribute their success to their own skill and expertise, when in fact their performance may be largely driven by luck. By recognizing the role of chance and randomness in outcomes, we can develop a more realistic and nuanced approach to assessing our own performance and the performance of others. We can also be more open to the possibility of unexpected outcomes and more willing to learn from our mistakes and failures. This can lead to more humility, discipline, and long-term success in financial markets and in other areas of life. Point 8 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that we often underestimate the role of chance and overestimate the role of skill and expertise in our lives and in financial markets. This bias can lead us to attribute success or failure to our own abilities or actions, when in fact chance events or external factors may have played a significant role. For example, a successful investor or trader may attribute their success to their own skill or expertise, when in fact their performance may have been largely influenced by external factors such as market conditions or luck. Similarly, we may underestimate the role of chance in our personal lives, and attribute success or failure to our own abilities or actions, when in fact chance events or external factors may have played a significant role. By recognizing the role of chance and randomness in outcomes, we can develop a more humble and realistic perspective on our own abilities and actions. We can also be more open to the possibility of unexpected outcomes and more willing to learn from our mistakes and failures. This can lead to more disciplined and prudent decision-making, and a greater likelihood of long-term success in financial markets and in other areas of life. Point 9 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that we often confuse correlation with causation, and fail to recognize that many observed relationships may be spurious or coincidental. In financial markets, this bias can lead to the development of spurious trading strategies that are based on coincidental patterns in data. For example, a trader may identify a pattern in historical stock price data that appears to be predictive of future price movements, when in fact the pattern is purely coincidental and has no predictive value. Similarly, in other areas of life, we may observe correlations between variables and assume that one variable causes the other, when in fact the relationship may be spurious or coincidental. By recognizing the potential for spurious relationships and coincidental patterns, we can develop a more rigorous and evidence-based approach to decision-making. We can also be more open to the possibility of unexpected outcomes and more willing to test our assumptions and hypotheses. This can lead to more robust and reliable strategies in financial markets and in other areas of life. Point 10 from Fooled by Randomness, the hidden role of chance in life and in the markets highlights the fact that we often fail to recognize the impact of rare events or outliers, and underestimate the likelihood of extreme outcomes. In financial markets, this bias can lead to the development of investment strategies that fail to account for the potential impact of rare and extreme events, such as market crashes or financial crises. For example, an investor may assume that a particular investment strategy is safe and reliable, based on historical data and past performance, when in fact the strategy may be highly vulnerable to rare and extreme events. Similarly, in other areas of life, we may underestimate the potential impact of rare events or outliers and fail to prepare for or mitigate their effects. By recognizing the potential impact of rare events and outliers, we can develop more robust and resilient strategies in financial markets and in other areas of life. We can also be more open to the possibility of unexpected outcomes and more willing to prepare for and manage risk. This can lead to more disciplined and prudent decision-making, and a greater likelihood of long-term success and survival in the face of uncertainty and unpredictability. Thank you for your interest in this book. You can find links in the description of this video, where you can purchase and download this book.